We're analyzing Monster Beverage, stock ticker MNST, to see if it's a great business on sale. This analysis is around 10 minutes. It's going to be intense, but it's going to be worth it. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Monster Beverage. Then we're giving a final rating to the business. Before we get into these valuable metrics, let's understand Monster Beverage's stock performance. Right now, Monster Beverage trades for $58.10 per share. Year to date, their stock price is up 14.5%. In the last 5 years, Monster Beverage compounds at 13.5%. In the last 10 years, they're compounding at 19% annually. Going back before the global financial crisis, Monster Beverage has compounded at 30% annually in the last 18.5 years. They're far and away one of the best performing stocks over this time. Monster Beverage's stock price is up more than 100 times in the last 2 decades. Right now, Monster Beverage trades $2 below their 52-week high. The company's up $16 from their 52-week low. Around 1% of their shares are sold short. Monster Beverage is a big business. They have a $61 billion market cap. But the burning question is, why should we be paying close attention to Monster Beverage? Monster Beverage is a leader in the energy drink subsegment of the non-alcoholic beverage market, generating 2/3 of revenue in the United States and Canada. The well-known Monster trademark includes brands such as Monster Energy, Monster Ultra, Java Monster, and Juice Monster. The firm also owns other energy drink brands such as Reign, NOS, Burn, and Mother, and brews and distributes beer and flavored malt beverages following the acquisition of a craft brewer in 2022. Monster controls branding and innovation, but outsources beverage manufacturing and packaging to co-packers and finished good distribution to bottlers in the global Coca-Cola system. They have a 20-year agreement with Coca-Cola that was signed in 2015. Coke is the largest shareholder of Monster with a 19.5% stake in the business. Now with that understanding, let's get into the numbers. Starting with metric number 1, we want Monster's average return on capital in the last 5 years to be above 14%. The average business earns about a 7% return on capital. Looking for a benchmark that's double this can build in margin of safety based on the quality of the business. Monster's returns on capital have been above average in all 5 of these years. They have been declining throughout this time. They earned 36% returns in 2018. These were down to 22.5% in their last fiscal year. Averaged out over this time, Monster earns 30% returns in a given year. That's more than 4 times better than an average business. This is a huge check on metric number 1. Metric number 2, we're looking for growth to go along with their high returns on capital. We want to see revenue, net income, and free cash flow growth up until today. This metric's all or nothing. All 3 need to be up for this to be a check. In this time, Monster Beverage has grown their revenues by 70%, including till today. Their earnings are up by 30%. Their free cash flows are just barely up over this time. They've grown less than 0.5%. So while these are pretty much flat, this is technically growth. This is a check on metric number 2 for Monster. Metric number 3, we're looking at Monster from the view of an individual shareholder. We want to see earnings per share growth in the last 5 years. We just learned Monster's grown their earnings by 30%. They've also bought back 6% of their shares outstanding. These two are both working together. This is a check on metric number 3. Monster's grown their earnings per share over this time. Metric number 4, we're looking for free cash flow per share growth in the last 5 years. This is similar to our last metric. Monster's free cash flows were down in their last fiscal year. When we include their numbers up until today, these are actually up. Between their 6% share buybacks and their very slight earnings growth, this is a check on metric number 4. Monster's starting off hot. They're 4 for 4 so far on our analysis. Can they keep this up? But there's still one vital piece missing. You might think nailing returns on capital and having strong growth is the key, but we haven't touched on the one thing that I believe sets Monster apart, which is having these without using a lot of debt. Metric number 5, we want Monster's net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. Monster's had negative net debt in all 5 of these years, meaning they're left over with cash after paying off their debts. Today, they're sitting on about $3 billion in cash. In the last 5 years, Monster's generated $5.25 billion worth of free cash flow when we add all these up. Monster has a strong balance sheet and they generate a lot of free cash flow. This is a Monster check on metric number 5. They seem to be in good financial position. Monster is flawless through our first 5 metrics. Can they keep this up and be a perfect Select 6 stock? Let's find out. The big metric of them all, metric number 6, we want Monster's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for Monster. Right now, Monster has a $58 billion enterprise value. This accounts for both their market cap and their net debt position. It looks at Monster similar to it being a private company. We learned in the last 5 years, Monster generated $5.25 billion worth of free cash flow, meaning they're generating just over $1 billion in an average year. When that's divided by their $58 billion enterprise value, we get around a 1.8% average free cash flow to enterprise value yield. On a current basis, Monster produced $1.1 billion of free cash flow in their last 12 months. When that's divided by their enterprise value, we get a 1.9% current free cash flow to enterprise value yield. Both of these are coming in below the yield of the 10-year treasury, meaning they're below our risk premium as well. Coming in all the way on our last metric for Monster, this is our first and only X of the day on metric number 6. Don't just throw Monster out, we still need to estimate their fair value per share and give our final rating to the business. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Monster Beverage, which takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. Monster's been a pretty predictable business in its past. We're starting with an average of their last 3 fiscal years worth of free cash flow, then using historical assumptions to grow these into the future. It's up to you to figure out if these will be accurate or not for the business. Assuming Monster grows their 3-year free cash flows at a rate of 12% annually for the next decade, then in the following decade, assuming that this growth rate is cut in half and they grow by 6% annually, we're adding in their tangible book value, which gives an estimate of their net worth. If we want a 15% rate of return, which is what Warren Buffett looks for, from today's valuation multiples, if these are the same 20 years from now, an estimate of Monster Beverage's fair value per share is around $17.50. That's down about $30 from the company's current stock price. One thing to note, Monster's trading at historically high multiples, especially given the size of the business. Also, Monster's been predictable in their past. That's not a guarantee for the future. This discount rate is an estimate of total returns to shareholders. If Monster were to start paying out a dividend, their dividend yield would be included in this discount rate. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll give our final rating to Monster, but we need to address something first. We've covered the numbers, but the qualitative factors may be even more important for Monster's business. What are they? Well, let's find out. Looking at the factors supporting a long thesis, number 1, Monster stands to gain volume share as the maker of rival brand Bang, with high single-digit volume share in the United States, filed for bankruptcy in 2022. Number 2, Monster has broadened its appeal to health-conscious consumers with better-for-you drinks including zero sugar, zero calorie offerings, and beverages containing only natural ingredients. Number 3, strong energy drink demand coupled with Monster's strong innovation pipeline bodes well for high single-digit top-line growth in coming years. We need to cover the negatives as well, looking at the factors supporting a short thesis. Number 1, the firm faces an uphill battle to advance its low single-digit volume share in Asia Pacific, which is 35% of global energy drink demand, given stiff competition from Red Bull's sister company, TC Pharmaceutical, and other well-established local brands. Number 2, PepsiCo has stepped up investments in its own energy drink portfolio, including an investment in Celsius, potentially posing threats to Monster's dominance in North America. Number 3, regulatory scrutiny and administrative restrictions in the United States and Europe will likely persist and could erode Monster's brand intangibles and retail demand. There you have it for a balanced perspective of some of the qualitative factors of Monster's business. Now it's time to give our rating. In analyzing Monster Beverage, stock ticker MNST, maker of Monster Energy, we learned the company has many of the signs of being a wonderful business. They've grown, they earn very high returns on capital, they generate a lot of free cash flow, they bought back shares, and they have a negative net debt position, meaning they have a strong financial position. It's worth reiterating this analysis is not financial advice. Monster was off when it came to its valuation. Its free cash flow to enterprise value yields don't look attractive compared to the yield of the 10-year treasury. When we performed our discounted cash flow analysis, if today's valuation multiples are the same 20 years in the future, you believe those assumptions, and you want a 15% rate of return, an estimate of Monster's fair value per share is around $17.50. Monster was last at those levels toward the end of 2015. You'd need to be patient. Looking at all the factors of our analysis, Monster looks like a strong candidate for further research. It has the signs of a wonderful business, but its valuation may be ahead of itself. This is not a buy or sell recommendation of any security. If you enjoyed today's video, be sure to like it, subscribe to the channel for more stock analysis videos, share your thoughts about Monster Beverage in the comments below, and let me know what business to look at next. Thanks for learning about Monster with me, and have a great day.